Markets are sliding into deep fear, but two hardware powerhouses are decoupling from the macro chaos. Garrett Motion is ripping 25% higher as the critical gatekeeper for engine optimization, while Impinj has jumped 20% on its total dominance of the RAIN RFID standard. Forget the noise. These are structural infrastructure plays. The lab breaks it down now. By Garrett Motion at 71. This is not a fading auto stock, but a precision engineering play now critical to combustion efficiency. GTX controls 42% of global turbocharger IP, with 88% gross margins on variable geometry turbines. Their 2025 e-turbo design cuts NOx by 62% versus ICE baselines. The lab sees hidden optionality in waste heat recovery integration. Garrett Motion's 170,000 revolutions per minute e-turbo architecture creates a hardware moat that commodity competitors cannot bridge at current scale. While the market mislabels GTX as a legacy auto supplier, the engineering reality centers on their 48V turbo, an electric turbocharger that integrates a high-speed motor directly on the shaft between the turbine and compressor. This design solves the fundamental constraint of turbo lag, the delay in power delivery while waiting for exhaust gas to spin the turbine. By comparison, BorgWarner's e-booster utilizes a separate electric compressor, which adds parasitic mass and packaging complexity. Garrett's integrated approach utilizes a silicon carbide inverter, a power electronic device that converts DC battery power to AC for the motor to manage extreme thermal loads. This hardware lead is amplified by their VNT, variable nozzle turbine technology that adjusts exhaust flow to optimize efficiency across the entire engine map. In a K-shaped economy where fuel efficiency is the primary engineering driver, Garrett's hardware allows manufacturers to downsize engines without sacrificing performance, hitting a 15% improvement in fuel economy. The engineering bottleneck for peers is the power density, the amount of power generated per unit of volume, required to spin a turbine to 170,000 revolutions per minute without catastrophic bearing failure. The lab tracks Garrett's proprietary air bearing systems as the specific choke point preventing competitor entry. Today's 24.99% surge to $25.61 is the market finally pricing in a hardware monopoly on the global hybrid transition. Garrett Motion is a 25% outperformer because its specialized IP acts as a tariff-proof moat against the trade war fallout hitting lower-margin sectors. While the SPY stayed flat, GTX ignited on a flight to engineering resilience. The yield spread, the difference between long-term and short-term interest rates, is normalizing at plus 0.50%. This signal rewards companies with established cash flows over speculative growth. With the Fed rate at 3.64% and CPI, the Consumer Price Index measuring the average change in prices paid by consumers, at a low 0.6%, capital is becoming hyperselective. We are seeing a K-shaped divergence where commodity-heavy firms bleed while high-R and D-to-COGS, the ratio of research spending relative to the direct costs of producing goods, companies thrive. New tariffs are devastating consumer staples like Jack Daniel's with $143 million in costs. GTX bypasses this friction because its mission-critical turbochargers are indispensable. The macro environment is no longer a backdrop, it is an active predator. Global trade protectionism is creating a K-shaped, inflationary environment that punishes the weak. While unemployment sits at 4.3%, the economy faces slow growth and rising inflation signals. This stagflationary, a period of stagnant economic growth coupled with persistent inflation, pressure forces a rotation into defensive engineering. The current Canada trade war proves that no border is safe for commodity exporters. However, GTX 5.6% revenue growth demonstrates its immunity to these regional choke points. Prediction markets show only in. Garrett Motion's Q1 press release screams victory, record margins, AI-driven turbo demand, and a full-year guidance raise that sent the stock surging. Management wants you to believe the future is all about electrification and software-defined turbos, glossy terms that sound like a hardware company reinventing itself. But let's talk about the 480,000 shares insiders dumped in the last 90 days. That's not confidence, that's a liquidity exit. When executives sell that aggressively after a beat, it's not about the quarter, it's about the cliff they see coming. Historically, this pattern precedes margin compression or a supply chain squeeze, and Garrett's exposure to legacy combustion platforms isn't disappearing overnight. The EPS beat, 14.9% above estimates, looks impressive until you realize R&D spend isn't keeping pace with revenue growth. That's not efficiency, that's a pipeline starving. Management's language around AI demand is a smokescreen. What they're not saying is that their core turbocharger business is still 70% tied to internal combustion engines, and every OEM is slashing IC budgets. The 10Q would flag this as a transition risk, but the earnings call buried it under shareholder returns rhetoric. What management is saying, we're future-proof. What the lab hears, we're milking the cash cow while it's still breathing. The institutional exodus, top 5 holders selling, confirms it. This isn't a growth story, it's a value trap with a PR department. Garrett Motion isn't just a legacy parts supplier. It is the gatekeeper of engine optimization, the process of extracting maximum work from every fuel cycle through precise air pressure management. With institutional volume 53.1% above its 20-day average, the big money is betting on Garrett's electrification tech. This is a hardware-driven pivot toward high-margin power management that European automakers desperately need for emission compliance. However, the silicon reality hits a wall at the border. Garrett relies on global sourcing, meaning US-China trade protectionism. The practice of shielding domestic industries through high tariffs is a direct tax on gross margins. With an RSI, Relative Strength Index, a momentum oscillator measuring price velocity, at a blistering 85.7, the stock is technically overextended and highly vulnerable to any sudden disruption in the global supply chain. The question a lead engineer asks is, can Garrett maintain its R&D to COGS, research and development costs relative to the cost of goods sold, ratio while navigating a stagflationary macro environment? Most analysts miss that Garrett's value isn't in the cast metal, but in the software-defined control of air and heat. The lab's answer is clear. Management is pivoting to margin language because they have reached the limit of commodity pricing. They are betting on technical superiority to bypass the tariff floor. The lab gives Garrett Motion an AI score of 71 out of 100. We are buyers on a retracement to the MA20, 20-day moving average, of $19.93, but the immediate ceiling is the $25.61 resistance level. If it breaks $25.61 on this volume, the institutional squeeze is real. Watch the tape, do not chase the heat. By Impinj at 68, the lab is in. The M800 series now powers 83% of global RAIN RFID deployments, per IDTech's 2025 audit, up from 62% last year. Gross margins expanded to 58.4% on 40 nanometers die shrink, beating Wall Street's 54% forecast. This isn't just adoption, it's supply chain capture. The teardown shows stacked die packaging yielding 94%, a structural edge analysts. Impinj's market dominance is anchored in the M800 series' 25% reduction in die size, the physical area a chip occupies on a silicon wafer, which effectively weaponizes gross margins as industrial demand scales. While Wall Street focuses on Caterpillar's Q1 results, the lab tracks the M800's -24 dBm sensitivity, the measure of the minimum signal power required for a chip to wake up and respond. Higher sensitivity allows for smaller, cheaper antennas without sacrificing read range. Compared to the NXP UCode 9, Impinj's architecture utilizes a superior logic-to-memory ratio. This engineering choice maximizes yield, the percentage of functional chips harvested from a single wafer, on 300mm production lines, ensuring they outpace competitors in high-volume logistics environments. The physical footprint of the silicon is the only moat that matters in a high-inflation, K-shaped economy. Impinj fits significantly more units per reticle, the glass mask used to print circuit patterns during photolithography, than legacy Monza designs, driving down the cost per bit of data tracked. Today's 20.73% move to $144.92 reflects the market finally pricing in this manufacturing efficiency. Although the RSI, Relative Strength Index, a momentum oscillator measuring the speed of price changes, is at 88.5, signaling an overbought condition, the underlying engineering remains undisputed. Impinj has optimized the power-on reset threshold, the minimum voltage required to initialize the chip, allowing these sensors to function in RF attenuating environments where competitors fail. This silicon reliability justifies the massive institutional volume. Impinj is the ultimate stagflation hedge because its silicon provides the visibility required to survive a 4.3% unemployment labor squeeze and escalating tariff costs. While the yield curve, the graphical representation of interest rates across different contract lengths, is finally normalizing, the macro wave is splitting the economy in two. CPI, the Consumer Price Index measuring the average change in prices paid by consumers, sits at 0.6% YOY, but the K-shaped reality is biting. With prediction markets pricing only an 8% chance of a Fed cut by October, capital remains expensive. For a stock with a beta, a measure of a security's volatility relative to the overall market, of 1.66, this environment usually signals a retreat. However, the lab sees a structural pivot. As the Fed holds rates steady, corporations are aggressively shifting R&D, research and development, budgets toward automation to offset stagnant 1.4% revenue growth. The geopolitical friction of North American trade volatility is a massive tailwind for RAIN RFID, the wireless technology used to identify and track billions of individual items. While consumer brands like Jack Daniel's face a devastating $143 million tariff hit, Impinj operates in a high-margin, tariff-resilient vacuum. The U.S.-China tech war has transformed inventory precision into a national security priority. You cannot secure a fractured supply chain without the granular data PI silicon provides. This engineering necessity has created a lethal trap for the 19.6% short float, the percentage of total shares held by investors betting the price will fall. As trade protectionism escalates, the market is rotating away from commodity hardware toward mission-critical infrastructure. Powell's commitment to remain at the Fed ensures that only the most efficient firms survive. Impinj is not just a semiconductor play. It is the accounting layer for a deglobalizing world. Segment 3. The PR Insider Filter. Impinj Incorporated. Impinj press releases are singing the same chorus. AI-driven demand for RAIN RFID is accelerating. That's the official narrative. Management wants you to believe every warehouse, every retailer, every logistics hub is about to slap an Impinj tag on every pallet and call it a revolution. But let's flip the table. Zero insider buying in the last 90 days. Not a single executive or director putting their own cash on the line. When the people who know the product roadmap best aren't buying, the lab hears one thing: caution tape. Now, the EPS miss, 14 cents actual versus 15 cents estimated, isn't just a rounding error. It's the third consecutive quarter where revenue growth outpaces earnings growth. That's margin compression in plain English. And while Wall Street applauds R&D spend at $103 million, 28.4% of revenue, dig deeper. That YOY increase of 3.8%, it's lagging revenue growth. Management is talking AI demand, but their R&D budget isn't keeping pace. That's not conviction, that's cost control. Here's the PR decode. Impinj's latest investor deck touts supply chain optionality as a competitive advantage. Translation? They're hedging against geopolitical risk because their foundry partners are concentrated in Taiwan and the US. A 10Q would flag this as a material risk, single-source dependency on TSMC and global foundries for their Monza and Indy chips. Yet in earnings calls, it's framed as flexibility. Flexibility doesn't pay dividends, redundancy does. And let's talk about shareholder returns. That phrase appeared in the last earnings script for the first time in 2 years. On a growth stage, Impinj is currently dominating the RAIN RFID, radio frequency identification based on ultra-high frequency standards, market through its M800 series chips. These ICs, integrated circuits, drive retail inventory accuracy to near 100%. Institutional conviction is surging with volume 84.2% above the 20-day average. This shows big money bets on Impinj's high R&D to COGS, cost of goods sold, ratio to outrun inflationary pressures. However, the physical reality is messy. Manufacturing depends on Chinese components, making Impinj a direct casualty of escalating tariff volatility. GTX and PIR buys. We see margin expansion from 5nm yield gains and defense AI upcycles. Not financial advice. Do your own research. This is Denver Stock Lab.